So you see, this fractional reserve theory says if the banks have these excess reserves at the central bank, then we need to drive the money out into the economy. They need to lend this because that's what banks do. They lend this. But I've shown in my work this theory is wrong, and specifically, it's doubly wrong because the fact is that the reserves that banks
the money never leaves the central bank.
Yeah. Exactly. The bank's reserves at the central bank cannot leave the central bank. It's a closed loop. It's entirely under the central bank's control. And therefore, but you see how disingenuous this whole story is, because the public is being told the wrong story. It's easy to be misled when you see all these excess big reserves the banks have. Yes, they should lend the money to the economy. That's sensible. But they can't. They don't need to. They can create their own credit.
Yeah.
Now, this is where the negative rate policy is so dangerous, because not only will it not achieve its goal, you cannot drive these huge excess reserves. They come from the central bank's purchase of assets and bonds and from the banks. So now they have, they pay the banks in reserve. So that huge reserve piles the banks have with the central bank in the Eurozone is massive. But you cannot drive this money into bank lending. It's a physical impossibility. So you'll never achieve that goal. That's already a given. It's a given by definition. That's the system. It's an unalterable reality. You need to change the system if you want to change that. So that's not going to happen. But on top of that, there will be an effect, but not a positive effect. There will be a negative effect. Why? Now the banks, like in the Eurozone, let's take that example, they've essentially been forced to hold these huge excess reserves by the central bank through their so-called QE. I mean, I proposed quantitative easing as the first person in 1995 in Tokyo. It's published in the Nikkei newspaper, financial newspaper, 2nd of September 1995. We need a monetary policy, which I called quantitative easing, to get out of this post-banking crisis recession. And of course, it had to do with, I've told you already, all the solutions. How do you get out? You need the central bank to help the banks. But how do you help them? Not through negative rates. That hurts the banks, as I'll tell you in a minute. You help the banks by getting rid of their non-performing assets from the prior asset bubble that central bank policy had created. So the central bank can just purchase the non-performing assets at face value and they're gone. And the banks are healthy. And this doesn't cost tax money. There's no fiscal tightening and austerity needed for this at all. And then the central bank should try to get the banks to create credit. And that can be easily done. There's a whole number of ways in which bank credit creation can be encouraged, but it doesn't involve lowering rates or negative rates. Quite the opposite. You need a positive yield curve. You need to push up long rates, because then lending to companies becomes profitable. But what they've done is the opposite. So back to these negative rates. So the way they've done QE is they just purchased assets from the banks that were performing, namely the sovereign bonds and things like that. And the banks were then given these huge amounts of cash, which is the reserves at the central bank. And now the central bank says, now we're going to impose negative rates. You're holding these, hundreds of billions of euros in excess reserves. We're going to punish you now. We're going to apply negative rates. That means you have to pay us now for this. Well, okay, so banks are being taxed. That means they will get weaker. They have to draw resources from elsewhere. What we found in the Swiss banks is where this was done first. That's why they charged their customers more. The borrowing customers, the small firms that borrowed money, had to pay higher rates because the banks needed to get the money to give to the central bank, the negative rates from somewhere. In the Eurozone, there's so many banks, and say in Germany, this has the largest number of banks. It's highly competitive, so it's difficult for them to actually raise rates. So what will it do? It will force these banks out of business. So banks will die, they'll be forced to merge, and they will disappear, and they will accelerate this trend of a declining number of banks. But when you reduce the number of banks, economic growth is going to go down. The more banks you have, the better, because that's decentralized decision making. about this decision. Who is going to get how much money for what transaction? Is it going to be productive? Can it be serviced and repaid? That's a micro decision. You need to kick the tires. You need to be on the ground, check out the small firms. And you need hundreds, thousands of banks, and they have each hundreds and thousands of branches with thousands of loan officers. That's a good system. If you have one central decision maker, like in the Soviet Union, who decides how much money is going to be created, well, you can be sure this is not going to be productively put into the economy. It's going to be a disaster. So that's the trouble. And so therefore, negative rates will not achieve their goal. They will achieve the opposite of killing the banking system, killing the banks from the small banks up. The big banks will survive the longest because they actually make money on this so-called QE, these asset transactions, because it creates an asset bubble in particular financial instruments. So they're fine, they play this game. But the small banks, particularly the community banks, they have a mandate that essentially they can't invest so heavily in the bond market. They lend locally, but that becomes unviable. And therefore, they're driven out of business. And so that's the trouble. And then this whole negative rate policy is actually highly counterproductive. And there's no empirical evidence that it's positive for the economy, yet it's being still pursued by policymakers. They need to look at the empirical evidence and change these policies.